Hi, and welcome to the X22 Report. My name is Dave, and this is episode 1587A, and today's date is June 8th, 2018, and the title of the episode is Wealth Inequality Just Hit the 1929 Great Depression Levels. Now what? Let's get into the economic collapse financial news. Now, we know that Argentina is imploding, and we see a lot of countries where they're in a huge amount of debt, and they're trying to make ends meet, and it's becoming very, very difficult. And what we see here is that the IMF, they decided we're going to bail out Argentina. Now, really, they had no choice but to do this, because if they let Argentina fail, everyone would be pointing fingers at the central banker saying, look what you did to this country. So the best policy is to give them more debt. Now, Argentina right now is being bailed out with the biggest ever loan in IMF history. This is around $50 billion. And this is a 36-month standby loan, and coming in about $10 billion more than rumored earlier in the week. And of course, as we always know, it's always a lot more than what they originally thought. And I believe this is probably even going to go further than $50 billion, because this is not going to help the country. It's going to keep them in limbo, and they're going to end up in the same exact place. Look at all the other countries that receive more and more debt. You can't dig your way out of debt with more debt. It doesn't work. But what the central bankers always do is they place restrictions. They put different policies in place. The country has to push austerity on the people, and this is what we're going to see. Actually, the people always pay the price. It's not the governments, it's not the policymakers, it's not the wealthy, it's none of these people. It's always the everyday, hardworking people that have to pay the price for this debt. This is how the central banking system works. We see out in the UK, well, things are not going well there. We know there's a housing bubble problem there. We know there's a retail problem there. We know the economy's not doing well. And it's not just the UK, as we know. It's Australia, it's Canada, the United States, throughout Europe. It's all hitting everywhere all at the same time. And we see that the department store House of Fraser is saying it has plans to close over half its stores, including its flagship store in London's Oxford Street. And the company filed plans in court Wednesday to close about 31 stores and put over about 6,000 people out of work. And they're saying this is all because of online. Everything went online and we don't need the stores. This is absolutely ridiculous. All these stores have an online presence. They all have their system in brick and mortar. They all have it online. So it makes no sense whatsoever. And we know in the retail industry, online doesn't make up even half of what the brick and mortar stores are selling, their sales. And we see that this is a completely fake and phony news story. What's happening is that people just can't afford to go out shopping. Yesterday in the report, I talked about how the central banks, they can't control the spending. They can't control getting people jobs. They can't control any of that. And this is what we're seeing. So what they do is they create a narrative to make you think that, oh, it's not because people don't have jobs. It's not because people aren't making enough money. It's not because the way the system is today. It's all about online. And they always do this. Actually, before they were mentioning online, they used to blame all the retail sales when they declined on weather. Now, in every part of the world, you're getting bad weather? No. So that story never made sense, so they had to move it to online sales. If there was no such thing as online sales, guess what? They would have thought of another excuse to use. We see right now that U.S. consumer credit growth, well, it has slowed. Now, following last month's notable slowdown in the growth of consumer credit, its weakest since September of 2017, the expectations were that there was going to be this incredible bounce in April. And it looks like there was no bounce. Bianco Research noted ahead of this data, consumer spending has been rolling over into the spring of 2018. And what we're seeing here is that people have reached their limits in credit spending, and they don't have any more to give. Now, take this and put it with what is happening with the savings rate, which is declining right now. So we hit the limit on credit spending. People's credit cards are just too high, and they don't have any money saved. And add to this credit card delinquencies. And basically, Bianco Research, they're expecting credit card delinquencies to climb. And they're saying that it's going to be climbing over this year and next year. And credit searches are also falling, led by home financing. And we see that this is going to be a huge problem. And what does this mean? This means that the credit most likely is going to end up freezing. We've seen this before back in 2008. Actually, Bill Holter has been mentioning this quite a bit. And we are now looking at a situation where everything is going to freeze up. And we're going to most likely see the credit card usage drop. We're already seeing the U.S. consumer credit net change continually decline. This is going to decline further. Yes, they will pay off some of their credit cards. They will use the credit because people just don't have a way of making ends meet. And as the cost of living continually rises, and we know that wages aren't keeping up with the cost of living, a lot of individuals haven't received a cost of living raise. Well, all of this is going to decline, and this is what we're seeing. Now, add on top of that the housing problem. Now, we've known that the housing market has been in the bubble. We understand that these houses are overvalued. They've been pushed up to make everyone believe that the economy is doing well. Remember, the illusion that the central bankers use is they push up housing prices. Once housing prices continually rise, people get this sense of everything is okay. I have money in the house. Of course, this is not really your wealth because it's on paper. You'd have to sell your house to get that wealth, but people feel comfortable. And a lot of people go out and say, you know what, I'm going to take out an equity line of credit and I'm going to go use it in retail and buy things. But this time, this really didn't happen. We know that Case-Shiller has been reporting on 20 cities. We know that the central banks have pushed the bubbles up in 20 cities. And of course, Canada has a bubble, Australia has a bubble, the UK has a bubble, Europe has a bubble. There's bubbles all over the place. Now, Corelogic is out there, and Corelogic is reporting that residential real estate prices nationwide increased about 6.9% year over year from April 2017 to April 2018. The firm's home price index also shows a 1.2% rise on month-over-month basis from March to April 2018. Now, Corelogic market condition indicators showed that 40% of the 100 largest metropolitan areas were overvalued in April, compared to 28% undervalued and 32% in line with valuations. Now, the report uncovers a shocking discovery that the nation's top 50 largest residential real estate markets, 52% were overvalued in April. Well, what does that mean? Well, that means the cost of housing is way too high, outside of the income of everyday people. Let's go back to 2008, for instance. Home price to income ratio. Well, normally when you have a home price to income ratio, it's around 3.5%. Approaching 2008 bubble, we hit 5%. Where are we today? Well, we're at 4.5%. And this is with the central bank pushing this bubble up as hard as they possibly can. So these homes are overvalued, which means we're going to see the same thing happen that happened in 2008, but this time it's going to be worse because everything is artificial today. The whole thing is just going to come crashing down. And once it comes crashing down, game over. And we can see it's already happening. The bubbles are deflating in Canada, Australia, UK, the United States. And as interest rates rise, guess what? Mortgage applications decline. As people aren't getting the cost of living They're not going to go out and purchase a house. They're kicked out of the housing market. As more and more people lose their jobs, they can't find work. They will not purchase a home. We see this with the younger generation. They're supposed to be getting jobs, making more money, getting raises, buying maybe their first small house, then moving into a larger home. But again, this is not happening either. And this is not happening just not here in the United States, but it's happening in Canada. It is happening throughout Europe, Australia. And when all's said and done, this whole thing is going to come down. We're seeing the same signs that we saw prior to 2008. But this time, it's going to be much, much worse because we never fixed anything. All the central bankers did was create this gigantic illusion. They made you believe that everything was great. Everyone feels good. The banks were propped up with money printing. The government, they manipulated statistics to make you think that everything was great. So when everything falls apart, all of that is going to be exposed. The truth will come out of this gigantic illusion, just like it did in 2008. If we go back to that time, subprime securities, they weren't AAA. All these corporations, they needed bailouts. They knew they needed bailouts. They knew that these companies were failing. Credit froze up. They knew that this was all happening at the same exact time. We also see something else very interesting happening. We see that household wealth right now, well, it has hit all-time highs of about $100 trillion for the first time ever. Now, everyone's probably thinking this sounds great. This is fantastic. But there's a problem here. Let's go and look at the Fed's latest flow of funds report, which was released yesterday. The Fed unveiled the latest snapshot of the U.S. household sector as of March 31st, 2018. It revealed that $116.3 trillion in assets and a modest $15.6 trillion in liabilities, the net worth of U.S. households rose above $100 trillion for the first time ever, hitting a new all-time high of $100.8 trillion, increasing for 10 consecutive quarters. And this would be great news. It would be fantastic, saying that, wow, all Americans, they're wealthy. But when you look at this, there's a problem. Almost all the net worth, guess where it went? To the 1%. The 1% have all the wealth. Right now, the wealth inequality in the U.S. is now as bad as it was during the Great Depression, with the top 0.1% of the U.S. population owning as many assets as the bottom 90%. So we are back to where we were right before the Great Depression hit. I mean, let's think about this for a second. And this entire economy is built on a gigantic illusion. The economy is failing. And everyone remembers Ben Bernanke, who was head of the Fed, where he couldn't forecast anything in the year that we had the recession. All of a sudden, he's an expert at forecasting. And he's saying that the U.S. economy is going to go off the cliff in 2020. Most likely, we're going to see the economy go off the cliff way before that. And we're going to see more and more signs of the economy failing. And we know that what is happening here is that the economy was always going to fail. It was never going to make it past this point. Actually, it made it a lot further than anyone even thought it could make it. But we can see right now with all the indicators and all the signs, the entire system is just imploding everywhere. And it's not just imploding in the United States. We're seeing all the signs now in other countries, which is a bad omen. We also see it with the banking system. Look at Deutsche Bank today. Look at the Italian banks. Look what's happening here. Look at the countries of Argentina. Look at the country of Venezuela. Look at all these countries. Look at Jordan, where people were protesting because they didn't want austerity. It's starting to happen, and it's going to pick up pace, and it's going to get worse and worse and worse. And what Trump and the Patriots have done right now is they've given the economy a little bit of stimulus to prepare for what is coming. This system is going to transition to something else. And we know that China and Russia, most likely they're behind the new system. Remember, the Belt and Road system, this initiative, will increase global trade by as much as 12%, cutting trading costs by half for the countries involved. Trade between Asia and Europe, not including trade between EU countries, accounts for 28% of the world trade. So making those trade flows easier has a large potential impact. Countries in Eastern Europe and Central Asia are set to benefit the most, explaining that the benefits will depend on where trade costs fall. So if we really think about this, making trade flow easier, cutting the costs, it's going to benefit all these nations, and all these other countries that jump on board, they're going to get the benefit also. And we know that the United States is going to need a new method of trade. The old method of trade with everyone holding the dollar and, purchasing our goods, it doesn't work anymore. Actually, we're not manufacturing. We have a small manufacturing base compared to China, that this can't work anymore. This is why we need different trade deals. The globalist trading system no longer exists. That's out the window right now. I mean, yes, can things change? Of course they can. But right now, we are on a path where the global trading system is thrown out the window. We're moving in a completely different direction, because when this economy fails, we're going to need a new trading system. And there are countries that are continually joining the One Belt, One Road, the Silk Road. And more countries are looking at this saying, yes, we need to be a part of this. And I think eventually what's going to happen is the United States will be a part of this new trading system. Plus, with all the different bilateral trades, instead of having a global trading system. So if one country's trading system is in dispute, the others aren't affected. And there's not one centralized system controlling it. That's the way the central bankers want it. And all of this has to be done before the system crashes. This is why the U.S. has been put on stimulus for a little bit longer to get everything set up for this gigantic transition. And we're going to be transitioning away from the U.S. dollar into a different currency, most likely a cryptocurrency. Maybe at a high level, you have the petro yuan or something else. But at a lower level, I think the people are going to be using some form of cryptocurrency where the central bankers will not be involved. Of course, the central bankers don't want this. They want a centralized system where they control everything, because that's how their system works. But I do believe that this is going to be decentralized exchanges, and it's going to be free-flowing and a truth machine throughout the world. And we are headed in this direction, but we're going to go through the bumps. It's going to be difficult for many people that haven't been prepared for this. They're not going to know what's happening, just like in the 70s. People didn't know what was going on. All of a sudden, everything fell apart. We couldn't get fuel. They were telling us that, it was gold speculators and all the different stories they made up, and people were out of work. Unemployment was very high, and they were adjusting to the new system. But remember, that was a system we were on. We were coming off a stable system, moving on to a new system. This time we're moving from this unstable system to a brand new system, and we're no longer the reserve currency. And this is why we're going to feel the pain. This is why the transition is going to be difficult for many people, because they're just not prepared for it. So get prepared, because the transition is coming. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.